We are going to begin this morning, though, with the Consumer Price Index, which rose 0.4% in the month of February. But the report shows inflation is easing year over year. Last month, inflation was up 6% compared to a year before. It was 6.4% in January. So joining us now to talk a little bit more about this is CBS News reporter Sarah Ewall-Wice. All right, so what are we to make of these latest numbers?
All right. So what we know is inflation is still much too high, but you mentioned it is easing. It went from 0.5% in January to 0.4% in February, which is kind of what economists had expected. Of course, inflation down to 6% from 6.4% overall. You know, it's worth looking at the core inflation. This doesn't include these energy and food prices, which are often volatile, because that's what the Fed focuses on. And that actually accelerated in February. It's at 0.5%. After being 0.4% in January, though year over year it has gone down slightly to 5.5%. Overall, food prices up 9.5%, but that actually did ease some in February. And the good news is meat, poultry, and eggs, those prices have actually eased for the first time last month since the end of 2021. Energy prices are slightly down last month, though gas prices were up a bit. The biggest factor here in this is the shelter prices. That makes up about 70% of the increase. That's up 8.1% year over year. And it's really the services side of this equation that has been accelerating when it comes to inflation.
Sarah, seeing this latest inflation report, isn't the Federal Reserve in a tough position with the collapse of two banks as it moves to hike rates?
Yeah, a bit between a rock and a hard place here. And part of the reason is we saw that the SVB collapse last week was because of the steps taken by the Fed to hike rates. That was part of the reason. And they took the loss due to higher interest rates. Just a week ago, the Federal Reserve Chairman Jerome Powell was on the Hill telling lawmakers they may need to keep interest rates higher longer, and it suggested they could go back up to that 0.5 percentage point hike after easing to 1/4 percentage point in early February. The situations put the banks in a really tough position for them. It caused further distress for the banks, but the Fed still needs to address inflation. So there's some analysis that they could skip a hike at this upcoming meeting. It looks more like they'll go with that 1/4 percentage point hike, that smaller percentage hike, than that larger one that was suggested to lawmakers last week. But it really remains to be seen what exactly they'll do next Wednesday. Of course, they say they take this with the data coming in meeting by meeting.
So we saw the president yesterday, urging everyone to be calm, ensuring that the people who had their money in Silicon Valley Bank and in Signature Bank, they're going to get all their money back, or they're going to be able to keep their money, not just $250,000, but everything. That being said, does it appear as if people are remaining confident in the banking system? Regional banks really took a hit yesterday in the stock market.
Yeah, so it is a little too early to really say with confidence, and I expect the volatility in the markets to continue. As you mentioned, we did see those regional banks take a hit yesterday. The futures before the markets open this morning were great, considering not ideal overall. We've seen that, but better than they were. People who put their money in those banks are able to access them. That's what I want to emphasize. I think that allowed people to have a bit more confidence. The Fed took that decisive action there. People who were hit by these bank failures were the investors and the banks themselves who took the risk. And I think there will be a lot of questions moving forward in terms of what steps need to be taken moving into the future to address this issue so it doesn't happen again. But of course, that run on the banks, we are in a very different place than we were in 2008. And I want to emphasize that over and over again as we talk about this now.
Sarah, to your point, what does happen next? Because steps by federal officials have not come without criticism or questions.
Oh, yes. No, it depends on who you ask, but there has been both praise and criticism. And I think there are a lot of questions that regulators and lawmakers will need to address from here. I think it's worth looking at the Hill to see what steps members of Congress take. Of course, President Biden yesterday did call on them to act. Regulators also have a job to do. These two banks are currently running under FDIC management. So at some point, there will need to be further action. But for now, the FDIC is stepping in to assure people people that those banks are running like normal. And the Fed also has a say over review and its oversight. So has a review of its oversight. So they'll be looking at that. They're expected to say what came out of that review in May. So there's a lot of things to look at here. And then, of course, you mentioned there are lawsuits coming out of this for investors who are now suing the banks themselves. But a lot of questions in terms of how much money needs to be insured, also what steps need to be taken in the future with these regional banks and regulation. And so that'll all be stuff that unfolds over the coming weeks and coming months, really.
All right, Sarah, thanks so much for breaking it down.
Thank you.